Hey everyone, Longacres Finance here, and it's time to take a look at 3 exchange-traded funds that pay monthly dividends. Receiving monthly dividend income is very appealing to investors looking to create passive income streams, and the 3 funds we will go over today can do just that. The vast majority of dividend stocks pay dividends quarterly. However, many bills like your mortgage or utilities are paid monthly. This is where a monthly dividend paying fund gains its appeal. It allows for a more predictable level of income from month to month. Another appeal is faster compounding. If you currently reinvest your dividends back into dividend stocks or funds, in turn growing your dividend snowball, well, if you receive those dividends more frequently, monthly versus quarterly, you can reinvest them quicker, theoretically speeding up the compounding effect of that snowball. But there is a downside to monthly dividend funds as well. Typically, over longer periods of time, they tend to underperform the broad market, which is why you should be very selective with the fund you invest in. 2 of the funds I'll show you today have pretty solid historical returns, and one is a bit of an underperformer, but offers exposure to stocks the first 2 do not. Before we jump in and review the 3 funds, let me give you a few key details you should pay attention to when reviewing any dividend fund. First is the expense ratio. Many investors will glare over the fees associated with investing in a fund and focus more on returns. But oftentimes the returns you see can be shown gross of fees, and a high expense ratio can eat away at a lot of that return. While there is no ideal gauge for what expense ratio is acceptable, I suggest to look for funds with fees of less than 1%. And preferably in line or below the industry average. All 3 of the funds in this list have an expense ratio well below 1%. Second is the price return of the fund. Most investors place their emphasis on the dividend stream and current yield a fund offers, especially when you're investing in a dividend fund. But I feel an equal amount of emphasis should be placed on the share price and capital appreciation of the fund. Ideally, you want the share price to appreciate over time, in turn growing your capital. When you seek high-yielding funds, oftentimes the opposite is the case. While a fund may pay you 8 to 10% in dividend income, you may be losing 2 to 3% of your capital per year at the same time. Personally, I would much rather earn a 5% dividend yield and retain my capital, or better yet, see it increase over time, rather than receive an 8% dividend yield but see my capital decline by 2 to 3%. Now you may say that both those situations yield the same result, a 5% annual return, and you are correct. However, what if you decide to move your capital to another investment in the future? Under the higher yielding scenario, you are now left with less capital to invest elsewhere, forcing you to seek a higher dividend yield to replace the same income level. If instead your capital appreciates, you may be able to replace your income stream with a lower yielding fund, or better yet, increase your income stream. Those are just a few considerations you should think about when deciding which dividend fund is right for you. Alright, no more tangents, let's go over the monthly dividend paying funds. First up is the very popular Invesco High Dividend Low Volatility ETF, ticker symbol SPHD. You've probably seen this fund in many articles and videos about monthly dividend funds, and rightfully so. It is an excellent choice with a solid history of paying and growing its monthly dividend stream. The fund charges a pretty low expense ratio of 30 basis points and has almost $3 billion in assets under management. The fund currently trades for a price of around $43 and has a 12-month distribution rate of 4.18%. The fund's average PE ratio is 15.53, which is about half of the average S&P 500 PE ratio, implying that it is about half as expensive as the broad US market. There are a total of 52 holdings in the fund. They are about equally split between large cap value and mid cap value stocks, with a little bit of large cap blend and mid cap blend mixed in there as well. Here are the top 10 largest positions in the portfolio, but actually let's take a look at all of the holdings. Here we go. The largest sector in the portfolio are utilities, making up 18.46%, with PPL being the largest position. The next highest sector are consumer staples, at 15.9%, with Ultra being the largest position here. Next we have information technology, making up 12.64%, with IBM as the largest position. Next are communication stocks, that make up 11.64% of the portfolio, with Lumen Technologies as the largest position here. There are 3 energy stocks making up 8.82% of the fund, with Exxon being the largest. There are also 3 real estate stocks making up 7.36% of the fund, with Iron Mountain being the largest position. The 4 material stocks make up 6.83% of the portfolio, with Dow being the largest position. There are also 4 healthcare stocks making up 6.6% of the portfolio, with Gilead Sciences making up the largest position. The 3 consumer stocks account for 5.35% of the portfolio, with Hanesbrands as the largest. There are 2 financial stocks in the fund accounting for 4.77%, with People's United Financial being the larger of the 2. Then we have 1 industrial stock, 3M Company, making up 1.54% of the portfolio. And finally, a money market fund and some cash on hand. You could certainly duplicate this portfolio by buying all these individual stocks, saving yourself the 30 basis points in fees. But this fund takes care of that for you, for the small fee they charge. Also, many if not all of these stocks do not pay monthly dividends. But SPHD takes all the dividends paid out by these companies and passes them on to investors in a nice monthly stream of passive income. Let's take a look at past performance and the dividend distribution rate. The fund has been around since November of 2012 and has a compounded annualized growth rate of 6.59% without dividend reinvestment from November 2012 to March 2021. This is purely a share price or capital appreciation return, which is very nice in this case, as many high-yield funds do not give investors any capital appreciation. Now, had you reinvested the dividend stream, your compounded annualized growth rate over the same period would have been 10.88%, a very solid double-digit growth rate. A $10,000 investment in November of 2012 would have yielded $905 in dividend income in 2020, as opposed to only $674 had you not reinvested the dividend stream. This is the power of compounded growth working here, giving you about 34% more income over a little bit more than an 8-year period. To me, reinvesting dividends seems like a no-brainer, unless of course you are already relying on that dividend income to fund your life. Looking at the dividend stream from this fund, we can see that the monthly dividend rate is not fixed, and has gone up and down around 14 to 15 cents each month. Now, 2020 may not be the best year to judge this dividend stream, as many companies stopped or cut their dividend payouts. If we scroll further down looking at the historical distributions, we can tell that generally the dividend rate has gone up, but that growth has not been consistent. I can also tell that the fund pays its dividend at the end of each month, with the ex-dividend date around the 20th day of each month, meaning that there is still time to get in before the April dividend payment. If you're enjoying the video, please click the like button and subscribe to the channel, it really helps me out. Moving on to fund number 2, and that is the Global X Super Dividend ETF ticker symbol SDIV. This fund charges a higher expense ratio of 59 basis points, but it does offer a juicier dividend yield of 6.77%. The fund also differs as it is focused on stocks from around the globe and not just the United States. It does have a cousin fund, ticker symbol DIV, that focuses on US only stocks and offers a slightly smaller dividend yield of 6.36% and charges a lower expense ratio of 45 basis points. I decided to focus on SDIV because having exposure to international stocks can be beneficial to many portfolios. In the recent past, US stocks have outperformed international stocks, but there have been periods of time where this wasn't the case. The fund trades for around $14 per share and has 101 holdings in its portfolio. The fund seeks to invest in 100 of the highest yielding equity securities in the world. If high yield is what you seek, this is a fund you want to look at. The PE ratio in 2021 is a nice and low 7.47, which is about half of SPHD's PE ratio. In the sector breakdown section here, we can see that the bulk of the portfolio are real estate holdings, with energy and financials also making up a decent chunk. The largest allocation of stocks comes from the United States, with China and Hong Kong making up the top 3 countries. We can see the top 10 holdings here, and since I'm not familiar with most of these names, I won't even bother going over it. You can check out Global X's website if you'd like to see all the individual holdings. I'll leave a link in the description below. I can however see that the allocation to the top 10 stocks is significantly smaller than that of SPHD, mainly due to this fund having a larger number of holdings. This could offer some downside risk if any of these companies were to go bankrupt or see its share price crash. The fund has been around since July of 2011 and has a compounded annualized growth rate of negative 5.89% between then and March 2021 without reinvesting dividends. That's right, negative 5.89%. This is exactly what I was talking about earlier, where many funds that pay a high dividend yield offer little to no capital appreciation. A $10,000 investment in July of 2011 would only be worth about $5,500 today. Had you instead reinvested the monthly dividends, the compounded annualized growth rate would have been 1.3%, which is still pretty terrible. You may wonder why this fund is even on my list. Well, if we take a closer look at this terrible return, we can tell that it is greatly impacted by a very terrible return in 2020. The fund lost 21.53%, but has been bouncing back from its recent low back in March of 2020. On a year-to-date basis, it is up 9.52%. The annual dividend income has also climbed for the most part through 2019, and then took a sharp dip in 2020. I think this fund will turn around, and may offer a healthy dividend stream in the future, but it certainly carries more risk than SPHD, and probably will offer little to no capital appreciation over the long term. The cousin fund, DIV, has offered a better overall return, and even paid more dividend income in 2020. But it hasn't been around as long, so it's not exactly an apples-to-apples comparison. Let's move on to fund number 3, and that is another offering from Invesco, the High Yield Equity Dividend Achievers ETF, ticker symbol PEY, or PAY, as in it will pay you money on a monthly basis. The fund trades for about $20 per share, and pays a dividend yield of 3.65%. The fund charges a 52 basis point expense ratio and has a total of 51 holdings in its portfolio. So it offers a smaller yield than SPHD, yet it costs more money to own. Wait till the end to see why it's on my list. The average PE ratio in the fund is 15.99, implying that the holdings are about half as expensive as the broad US market right now. The fund aims to invest in the 50 best stocks, selected on the basis of dividend yield and consistent dividend growth. So it's ideal for investors seeking a healthy dividend yield with a focus on dividend growth as well. Taking a look at the portfolio, we can see that it differs from SPHD in that it is about equally split between large cap, mid cap, and small cap holdings. But we can certainly see some overlap in both funds' holdings. The top 10 stocks include Altria, AT&T, PPL Corporation, Exxon, IBM, and Philip Morris, which all happen to also be in the top 10 holdings of SPHD. There are some differences though, as PEY has 24.4% allocated to utilities, where SPHD had about 18% allocated to this sector. Also, there is a significantly higher allocation to financial stocks, of 22.73%. If you remember, they made up less than 5% of SPHD's portfolio. I'll leave a link in the description below to all these websites if you'd like to take a closer look at the individual holdings. The fund pays about 6.5 cents per share on a monthly basis, and appears to use the same ex-dividend and pay dates as SPHD. The dividend stream appears to be growing over the long term, but varies from month to month. PEY has been around since January of 2005, giving them a longer track record for us to review. Also, we can take a look at how the fund performed during the financial crisis of 2007. Without dividend reinvestment, the fund has a compounded annualized growth rate of 1.75% since January 2005. That is pretty poor, but at least it's positive. Let's see if we can see what has happened here over the last 15 years. And sure enough, there was a very steep decline during the financial crisis, where the fund actually had a drawdown of over 70%, from January 2007 to February 2009. But since 2009, it has enjoyed some decent growth until, of course, 2020. If we instead reinvested the dividend stream, the compounded annualized growth rate over the same period is now 6.07%, which isn't too shabby for a high-yield approach. A $10,000 investment on January 2005 would pay $928 in dividend income in 2020, versus only $490 with no reinvestment. That is an almost 90% boost in dividend income through the power of compounding. If we do an apples-to-apples comparison of SPHD, SDIV, and PEY for the period of November 2012 to March 2021, PEY would be the winner with a compounded annualized growth rate of 13.55%. SPHD would finish in second place with a compounded annualized growth rate of 10.88%, and SDIV would finish pretty far behind with a compounded annualized growth rate of 1.92%. This shows you that chasing yield isn't always the best route for dividend investors. And while the dividend yield is an important factor to consider, you should look at the full return a fund offers as well. Of course, there are plenty of other funds out there that could have achieved better results over the same time period. Let me know which other monthly dividend funds you like in the comments below. That's it. Thank you for watching. See you next time.